Welcome to your deep dive into the world of ETFs.
Yeah.
You know, you sent over some really interesting articles and research, and we should unpack what makes these investment tools so popular.
Absolutely.
And why, you know, they might be a good fit for your portfolio. So imagine you make a single purchase, and instantly you own a tiny piece of hundreds of companies. It's like having a mini stock market right in your pocket. That's the potential ETFs. But before we get ahead of ourselves, let's break it all down. Like, what exactly are they and how do they actually work? So what exactly is an ETF? It stands for Exchange Traded Fund.
Right.
And it's essentially a basket of assets, like stocks or bonds or even commodities, that you can buy and sell on a stock exchange, just like individual stocks.
Mm-hmm.
So think of it as a prepackaged investment portfolio that's carefully designed to track a specific market index, a particular sector, or even a theme like renewable energy.
Yeah, and what's key here is that ETFs provide instant diversification. So instead of putting all your eggs in one basket, by picking individual stocks, you're spreading your risk across a whole bunch of companies with a single ETF purchase.
That makes a lot of sense, especially if you're looking to mitigate risk. What else makes ETFs so attractive to investors?
Well, they're also known for their liquidity. You can buy and sell them easily throughout the trading day, unlike traditional mutual funds, which are priced only once a day. Plus, ETFs generally have lower expense ratios compared to actively managed funds because they often track an index without a lot of costly human intervention.
Yeah, so lower fees. Easy to trade. That's appealing for sure. It sounds like ETFs can be a good fit for both seasoned investors and those just starting out.
Absolutely. And here's what's fascinating. Even big institutional investors like pension funds are increasingly using ETFs. It's not just a retail investor tool anymore.
Okay, so we've got a handle on what they are and why they're popular, but I'm curious about the behind-the-scenes workings of ETFs. How does it all come together?
It's actually quite a clever system with several players involved. You've got the ETF issuer, the company that designs and manages the ETF. Think of companies like Amundi Lixor or Vanguard. They set the rules, like which index they're tracking, what kind of replication strategy they're using, and of course the fees.
Right, and then you have these authorized participants. Are these the ones who actually make the ETFs happen?
Exactly. They're usually large financial institutions like banks who act as middlemen between the ETF and the actual underlying assets. They're responsible for creating and redeeming ETF shares to ensure everything runs smoothly.
So they're like the chefs, making sure there's always enough cake to go around.
That's a great analogy. It's a bit like a supply and demand balancing act. If more people want to buy the ETF, authorized participants will buy up the underlying assets and exchange them for new ETF shares with the issuer. And if people start selling the ETF, they do the reverse, redeeming shares and selling those assets back to the market. This creation and redemption process is vital. It keeps the ETF's price closely aligned with the value of its underlying assets, ensuring investors are getting a fair deal.
That's really interesting. So it's a dynamic process that keeps everything in check. And where does the stock exchange fit into all of this?
That's where ETFs are listed and traded, just like regular stocks. This is what makes them so accessible and easy for you to buy and sell.
Got it. And we can't forget the depository, where those underlying assets are actually held.
You're right. It's like a secure vault for the ETF's assets. Then you have the asset manager, the team responsible for ensuring the ETF stays true to its target index by adjusting the portfolio as needed.
It sounds like a well-oiled machine with a lot of moving parts. Now, I'm curious about how ETFs are actually structured. You mentioned something called replication strategies earlier. What exactly are those?
There are two main types, physical replication and synthetic replication. Let's start with physical replication. This is where the ETF literally owns the underlying assets of the index it's tracking. It's very transparent because you can see exactly what you're invested in. There's also something called optimized replication, which helps keep costs down.
Okay, optimized replication. That sounds interesting. How does that work?
With optimized replication, the ETF aims to closely track the index's performance without necessarily owning all of the underlying assets. Instead, they hold a carefully selected subset of the index components. This can be more cost-effective, especially for indices with a large number of constituents. Imagine trying to buy every stock in the MSCI World Index. Optimized replication helps manage that complexity.
So it's like capturing the essence of the index without having to buy every single ingredient. That makes sense. Now, what about the synthetic replication? Is that completely different?
It is a bit different. Instead of directly owning the assets, synthetic ETFs use derivatives, typically swaps, to replicate the index's performance. Essentially, the ETF enters into a contract with the bank, where the bank promises to pay the ETF the return of the index. in exchange for the ETF holding a basket of collateral.
That sounds a bit more complex. What are the advantages there?
Synthetic replication can be useful for tracking indices that are difficult to access directly, like certain emerging markets or niche sectors. And they sometimes have lower costs compared to physical replication. But there are considerations, of course.
Such as?
Well, you have to be aware of something called counterparty risk. It's the risk that the bank backing the swap might fail and not be able to fulfill its obligation.
That's definitely something to keep in mind. So both physical and synthetic replication have their pros and cons. Physical offers more transparency and potentially lower counterparty risk, but they might have slightly higher transaction costs. Synthetic can be more cost-effective for tracking certain indices, but they come with that added counterparty risk. It's a trade-off investors need to carefully consider based on their own risk tolerance. Now let's talk about the alternative to ETFs, buying individual stocks. Why would someone choose an ETF over picking stocks themselves?
There are several reasons. Imagine trying to replicate an index like the S&P 500 on your own. You would need to buy all 500 stocks in the exact same proportions as the index. That involves a ton of research transactions and constant management.
Sounds like a lot of work.
It is, not to mention the cost. Buying all those individual stocks would rack up significant brokerage fees, potentially eating into your returns.
And that's where ETFs shine, right? You get instant diversification with just one trade.
Exactly. And here's another advantage. ETFs handle all the rebalancing for you. When the index composition changes, the ETF automatically adjusts its holdings. So you don't have to worry about constantly monitoring and making adjustments yourself.
That's a huge time saver. Are there any tax advantages to using ETFs?
In some countries, ETFs can be more tax efficient than traditional mutual funds. And in France, for example, certain ETFs are eligible for PEA accounts, which are specifically designed for long-term equity investments. What's interesting about PEAs is that after 5 years, any capital gains you make within the account are exempt from capital gains tax, although you still have to pay Social Security contributions. This can be a significant advantage for investors with a long-term investment horizon.
So PEAs offer a way to potentially reduce your tax burden if you're investing for the long haul. That's definitely a point in favor of ETFs. So far, it seems like ETFs offer a simple, cost-effective, and diversified way to access a wide range of markets and assets, with potential tax advantages to boot. But wait, there's more. We're just getting started with our ETF journey. In the next part of this deep dive, we'll venture beyond the basics and explore the fascinating world of specialized ETFs.
I can't wait. Welcome back. So now that we have a good understanding of the ETF fundamentals, let's dive into some of the more specialized and nuanced types of ETFs that you might consider.
I'm ready to expand my ETF horizons. I've heard about things like hedged ETFs. What are those all about?
Hedged ETFs are specifically designed to address a challenge that often comes with international investing. Currency fluctuations. Imagine you're a US-based investor who's interested in a European ETF that tracks the Euro Stoxx 50. If the euro weakens against the dollar, your investment returns could be impacted, even if those European companies are performing well.
Oh, that makes sense. So a hedged ETF aims to neutralize those currency swings.
Precisely. By using currency hedging techniques, they try to isolate the returns of the underlying assets from those pesky exchange rate movements. Think of it as a built-in safety net for your international investments, which can be especially valuable in times of market volatility.
That's a clever way to manage risk. What other specialized ETFs are out there?
Well, there's a fascinating category called equal weight ETFs. In a traditional market cap weighted ETF, the companies with the largest market capitalizations have the most influence on the index's performance. But in an equal weight ETF, all companies in the index are given equal weighting, regardless of their size.
So it levels the playing field a bit, giving smaller companies a chance to have a greater impact.
Exactly. This approach can potentially mitigate the dominance of the mega-cap tech giants, which often have a large weighting in traditional indices like the S&P 500. It's a strategy that can be appealing for investors. We're looking for more balanced exposure, or want to tilt their portfolio towards small-cap companies.
It definitely adds a layer of diversification. Beyond just the sectors or countries represented in the ETF, are there any other types of specialized ETFs that you think are particularly interesting?
There's a whole world of them. Sector ETFs and thematic ETFs can be quite compelling. Sector ETFs focus on specific areas of the market, like healthcare technology or energy, allowing you to target your investments based on your outlook for certain industries.
So if you're bullish on renewable energy, you could choose a sector ETF focused on that industry.
Exactly. And then there are thematic ETFs, which target broader investment themes or megatrends, such as artificial intelligence, robotics, the metaverse. Really, the possibilities are endless. They offer targeted exposure to areas of the market that align with your invest beliefs or long-term investment thesis.
Wow, with so many options, it's almost like having a personalized investment toolbox at your fingertips. But with all this variety, it also sounds like choosing the right ETF could feel a bit overwhelming. Where do you even begin?
You're right, it's important to have a strategy. It all starts with understanding your own investment goals, risk tolerance, and time horizon. What are you hoping to achieve with your investments? Are you looking for long-term growth income generation? Or perhaps a combination of both?
So aligning your ETF choices with your individual investment strategy is key.
Absolutely. Once you've clarified your objectives, you can start to evaluate specific ETFs that fit that framework. There are some key factors you should consider, including expense ratios, the replication method used, dividend treatment, and the ETF's liquidity.
Okay, let's break those down a bit. We touched on expense ratios earlier. Those are the fees you pay for the ETF's management, right?
That's right. And they're typically expressed as a percentage of your investment, deducted annually. Lower fees mean more money stays in your pocket, which can make a big difference over the long term. It's always wise to compare expense ratios when choosing between ETFs, especially within the same category.
Got it. So lower fees, happier investors. Now, what about the replication method? We discussed physical and synthetic replication earlier, but how should an investor decide between those?
Well, remember that physical ETFs directly own the underlying assets of the index, which provides a lot of transparency. They can also be slightly less complex from a regulatory standpoint in some cases. However, synthetic ETFs might be more cost-effective, especially for tracking certain hard-to-reach indices.
Right, and we can't forget about counterparty risk, which comes into play with synthetic replication. It seems like there's a lot to weigh when making that decision.
There is, but understanding those trade-offs is crucial. Now, another factor to think about is dividend treatment. Some ETFs distribute dividends to shareholders, while others reinvest them automatically.
So if an ETF distributes dividends, I'd be receiving regular payouts, like a stream of income.
Exactly. But if an ETF reinvests those dividends, they use those payouts to buy more shares of the ETF, compounding your returns over time.
So reinvesting is like a snowball effect, growing your investment faster.
Precisely. If you're investing for the long term and don't need the immediate income, reinvesting can be a powerful wealth-building tool. And finally, you'll want to consider the ETF's liquidity.
Right. We talked about that earlier. It's about being able to easily buy and sell the ETF without large price fluctuations.
Exactly. High liquidity means there are plenty of buyers and sellers in the market, making it easier for you to enter and exit your position at a fair price.
Okay. All of that makes a lot of sense. Now, could you give us some real-world examples of popular ETFs and explain why they might be a good fit for different investor profiles?
Absolutely. Let's start with the iShares Core S&P 500 ETF, IBV. It's a very popular choice among investors seeking broad exposure to the U.S. stock market. It tracks the S&P 500 index, which includes 500 of the largest U.S. companies. And it's known for its low expense ratio and high liquidity.
So a good option for someone looking for long-term growth tied to the U.S. economy.
Exactly. Now, for investors who want to diversify beyond U.S. borders, the Vanguard Total World Stock ETF, VT, is a great choice. It covers both developed and emerging markets, offering a comprehensive slice of the global stock market with just one ETF.
And for someone who's a bit more risk-averse and looking for steady income,
the iShares Core U.S. Aggregate Bond ETF, AGG, could be a good fit. It invests in a diversified portfolio of U.S. investment-grade bonds. While it might not offer the same growth potential as an equity ETF, it tends to be less volatile than stocks and can provide a steady stream of income through interest payments.
Those are just a few examples, of course, but it's helpful to see how different ETFs can cater to various investment needs and risk profiles. What I'm gathering from our conversation today is that ETFs have really opened up a world of possibilities for investors.
I completely agree. And the ETF landscape continues to evolve. There are constantly new and innovative products being launched, so it's an exciting space to watch.
It really does feel like a vast and ever-expanding universe of investment opportunities, all conveniently packaged in ETF form. We've explored a lot in this deep dive, but I know there's always more to learn. In the final part of our ETF deep dive, let's talk about where you can go from here to continue your ETF journey, and maybe even discover your own dream ETF. Welcome back to our ETF deep dive. We've covered so much ground, from the basics of what ETFs are and how they work, to exploring specialized ETFs and even touching on some popular examples.
Yeah, it's been quite a journey. And I hope you're feeling more confident and informed about the potential of ETFs.
Absolutely. But like you said earlier, the ETF landscape is constantly evolving. So where can our listeners go from here to continue their exploration?
Well, there are so many resources available. You can find in-depth information on reputable financial websites, like those of major ETF providers. Think Vanguard, BlackRock, or State Street, to name a few. You can also delve into investment publications, both online and in print. And don't underestimate the power of your local library. They often have a wealth of resources on investing and personal finance.
It sounds like the key is to stay curious and never stop learning. And I love that this whole deep dive was inspired by the sources you provided. It shows you're already taking that proactive approach to learning about ETFs.
That's exactly the spirit. The more you understand about ETFs, the better equipped you'll be to make informed decisions that align with your unique financial goals and risk tolerance.
So true. Remember, there's no one-size-fits-all approach when it comes to investing. What works for one person might not be the best fit for another.
That's why it's so important to do your research, ask questions, and really understand the nuances of different ETFs before making any investment decisions.
Speaking of questions, we touched on this earlier, but I want to circle back to it. We talked about all these specialized ETFs and how they can target specific sectors, themes, or even investment strategies. What if you could take it a step further?
I like where you're going with this.
What if you could design your own dream ETF? An ETF that perfectly reflects your investment philosophy, your values, your risk appetite, and your long-term goals.
That's a thought-provoking idea. It would be incredibly empowering for investors to have that level of customization and control over their portfolios.
Imagine being able to select the exact companies, sectors, or themes that resonate with you, all within a single diversified ETF.
It's fascinating to think about. What would your dream ETF look like? What companies or themes would it include?
Well, that's something I'll have to give some serious thought to, but I encourage everyone listening to do the same. What would your ideal ETF be? What kind of impact would you want it to have, both on your portfolio and potentially even on the world?
It's a question that could spark some truly innovative and impactful investment ideas.
Absolutely. We've reached the end of our ETF deep dive, but the conversation doesn't have to end here. Keep exploring, keep learning. And who knows, maybe one day we'll see your dream ETF out there in the market.
It's been a pleasure joining you on this journey.
Thanks for listening and happy investing.
Here